Welcome to Power Charting. I am your host, Bruce Fraser. Welcome to all my Wyckoff friends. I'm so glad you're here. And for you new people, when it comes to Wyckoff, resistance is futile. Anyway, we're going to have a great episode today. I'm going to go really fast because there's a lot to cover. And the first thing I want to do is continue on a little bit with our discussion about inflation from last week. There's some additional points I wanted to make I couldn't get to. And then also we're going to get into the price cycle, talk about the importance of the price cycle related to recession and recession watch. And one of the ways we're going to do that is by looking at the yield curve. So here, the Wyckoff price cycle is the price cycle of the stock market. Individual stocks, they ebb and flow. They have their own heartbeat within the structure of the total stock market, but also they rhyme in most cases to what the stock market is doing. Mr. Wyckoff was really so brilliant on understanding the price cycle. And so we're going to talk about that today a little bit related to recession watch. So the other topic that we're going to cover, especially related to the yield curve and the fact that it's flattening right now, is the idea of recession watch and tight money timing, because the definition of a flattening yield curve is a tight money environment. So how tight is it? Can the market rally when the yield curve has flattened? Can the market rally when interest rates are going up? We probably can't cover it all today, but we're going to, and in future episodes, I will have some very special guests that are really good at analyzing these conditions. So will inflation return to normal levels? This is one of the areas that I wanted to cover more last week, and we will get into that a little bit. And then the present position of stock indexes at this time, and then followed up by sectors, groups, and stocks. And I can hear you thinking, you're going, gosh, is he bitten off more than he can chew? And I'm absolutely here to confirm that that's true. So here you can see the classic price cycle. Excuse the fuzziness. You've all seen this chart before. This is from Roman. He did this as a class project back in the 90s. It's a brilliant chart. And you can see here accumulation across the bottom of the price cycle. You can see the price cycle here as defined as like a moving average. It's not specifically a moving average, but you can see the price cycle. So accumulation, markup, distribution, markdown. Now, this is the really important part that I want to make, and this is all I'm going to talk about relative to this chart. And that is that economic cycle lags the stock market price cycle. Think of it as being a six-month lag. And get my little marker back here. And so we're looking out 6 months in time. So the economic cycle is going to look something like this. This is very simplistic, I know, but top in economic conditions and the slowdown comes at some point after the distributional top is put in stock prices. So they're not lined up with each other. And here, down here, you can see that the stock market will go under accumulation, will start to mark up, and the economy is still getting weaker. And so it's looking out 6 months into the future and seeing, and this is just 6 months is just sort of a, average relationship, but it will look out into the future, the stock market, and discount better conditions coming, will act ahead of the economy. This is one of the reasons why it's so difficult for investors to be able to make good timing decisions, is because the economy, the economic cycle and the economy itself puts us into either a good mood or a bad mood. And so when the economy, we're in recession, business is slowing, stocks are down, all of those things, we're in an economic psychological environment that's quite negative. It doesn't start to feel better for investors until you're already well into the advance in the economy. But look at how far up stock prices are by the time this is really a feel-good place. So you have to be willing to make decisions in the face of tremendous uncertainty, tremendous bad news at the bottom, and then in the glow of good news at the top, when the economy is super strong, earnings are good, all of a sudden stocks start to tail off. They act worse. They distribute themselves. And so into the face of the glow of great news, great conditions, the stock market starts to just drop. And so our emotions are never aligned with what's going on in the stock market. Now, let me go here to the CPI chart, which I showed you last time. Here, this is the 7.9 was the most recent reading. You can see 7.75. It's quarter point scaling. And so you can see we touched 7.75. We have not touched 8 yet. Very close, 7.9. We're very close. We're probably going to hit it in the next reporting period for March. Will the consumer pricing index continue to go higher and hit these higher numbers? It very well could. But my argument was that we, especially with tight money coming, that we may start to get some kind of a slowing here, and then maybe we could get a reaction of some type where it comes back some. I don't think it can come back very much. As a matter of fact, it wouldn't surprise me at all if we didn't come down into the 6-7% range. And this will not feel good to anybody, because 6-7% inflation is, I would describe, a disaster, and especially for savers and for investors and for people on incomes, retirees. This is 2% inflation is no good. Think of it this way: 2% inflation over 10 years, a decade, is more than a 20% reduction in purchasing power for the dollar. So can you imagine what 6% does? And here we are flirting with the 8% level, with the potential of it going higher. So if there is some kind of a backing up type action here down into the 6s or the 7s, this is going to be a Pyrrhic victory at best. It's not going to be a good thing. It's possible that the powers that be could declare victory because this line is going down. For us, our job is to maintain our purchasing power, especially in a world with a deteriorating purchasing power of the dollar. This is our job to be done. And so this is why we're going to keep working on this in the weeks ahead. I'd like to point out here that we are going to have a Wyckoff market discussion complimentary session on April 6th. Love for you to be there. Go to wyckoffanalytics.com and register for that event. It's really a lot of fun. Ramon and I spend an hour and a half just going over the current market from a Wyckoffian perspective, going into special topics and so on. So we really would like you to join us for that. And so here you can see this inflation migration. This chart actually created a little bit of controversy. Not a bad thing. I love controversy. I appreciate your feedback and letting me know your thinking. And there was some discussion about commodities, because this is a ratio of the NASDAQ 100 large cap growth stocks to the CRB Reuters commodity index. And so my contention is that we have a overbought condition after a 10-year uptrend of growth stocks to commodities and virtually just about everything else. But after that overbought condition above the trend channel here in 2020, in the beginning of the second quarter of 2020, really kind of unbeknownst to people, because there was just tremendous party of speculation all through this period. But what does this look like? Think back to the chart we just looked at. here is the price cycle. And so here's our big uptrend. Here's a potential price cycle distribution area and a markdown. And look at how much the commodity prices are outperforming stock prices, especially the most important growth stocks. I contend that these growth stocks have become a source of capital for the composite operator types, and they are using their sales and their prior sales of these large cap stocks to go into other areas of the market. The controversy really was about whether or not commodities is a solid place to be. And I'm not saying that it is at all. I'm showing you the phenomenon of what's going on here on a relative strength chart. But what I am saying, and what I think we're seeing in the country, in the world, is that these large moneyed interests that are really on the cutting leading edge, they're the ones that create accumulations. They're the ones that create distributions because they are thinking 6 months to a year ahead of the economy. They are the ones that are the best at anticipatory behavior in the financial markets. And this is just a reflection of a condition that's much wider. And that condition is that money is starting to migrate into real assets, whether it be farmland or whether it be commodities or the energy sector in the form of stocks or actually owning energy producing properties, etc. There are many, many ways to participate in the real economy if these prices are growing faster than stock prices, if these prices are growing faster than inflation. That's the key. And the other part of this that we've talked about, and I've gone on a rant here, but the other part of this is that when you have 8% inflation across the board, you have 15, 20%, 30% inflation in food and energy and these other places, there is a huge yawning gap of opportunity for these speculators to be able to borrow money at low interest rates and be able to speculate and accumulate these assets that are appreciating at these much higher levels. They can cover the cost of borrowing money, they can pay the interest on that, and then they can leverage that ownership by growing the value of those commodity assets. Now, commodities, we need to think of this in a much broader term than thinking about it just as the commodity market. It's many, many different things. And so I use this as a somewhat of a symbolic reflection of what's really going on. But also keep in mind here that this drop has been quite dramatic, and that this drop is likely to have a counter trend move of sorts. And it could very well be that it could move all the way back up into this trend line, maybe even into the channel. Who knows? But we'll be watching and keeping an eye on it right here. So anyway, this is just to further reflect on these issues. And again, if I can't get to all this today, oh, by the way, I'm doing a YD5 on Monday with Johnny Scan, so tune into that also. Yield curve. We talked about the yield curve last week. And so here you can see is over here, there's a point and figure chart that we made of the 10-year yield. And so there's a cause built back to 2019. I showed this last week. I won't spend much time on it, but it shows a count potential that goes up as high as 3.2%. And so here is the prior high that was made in 2018, right at 3.2%. So there's classic resistance up here, right where our point and figure extreme target is, makes perfect sense for where yields could go. Now you're thinking, because you're all just really sharp Wyckofians, you're thinking, well, 3.2% is nowhere near 8% inflation. And in fact, what has to happen, and we saw this with Paul Volcker and some other really good Fed chiefs, is that interest rates, to stop inflation cold in its tracks, you must get the interest rate, the risk-free interest rate, up to the level of the inflation rate, arguably even higher. The normal relationship is for interest rates to have a positive yield, the risk-free rate, which would be Fed funds, a positive interest rate to the inflation rate. So that would be something above 8%. And that's why the Fed is so shocked right now about how high these inflation levels are and why they so desperately want them to be transitory, because the notion of getting interest rates up to anywhere near that level is just would be a shocking event for the economy. And the Fed knows this. And so they have, basically two mandates. One is full employment, and the other is steady, stable prices, low inflation, or no inflation, preferably. And so here they are. These two things, unemployment rate or employment rate, let's say, and stable prices, are really contrary to each other in policy decisions. You raise interest rates, you create a tight money environment, and in that environment, it's going to inevitably result in a slowing economy and higher levels of unemployment. So these two conditions work against each other. And so the Fed's got to make tough political decisions to be able to create a steady state environment where conditions are good for economic growth, good for stable prices. Hard to do. And they are in contrast to each other. Here on the right is the yield curve. And the yield curve, as you can see, is dropping precipitously. It's down about 20 basis points. This is the 2-10 yield curve. All that is just 2-year US Treasury yields minus 10-year US Treasury yields plotted. And so when the number is positive, that means 10-year yields are above 2-year yields. When it's negative, it means that the yield curve is inverted. 2-year yields are higher than 10-year yields. Kind of nonsensical, but that's in fact something that does occur. And so look here, look at this beautiful accumulation structure in the yield curve chart. They're everywhere. And so you can see these beautiful accumulations and distributions along the way. Well, now we're seeing interest rates, these bottom two lines. This is the 10-year here. Here's the 2-year. They're both rising. Well, let's look at this more from a historical perspective. I showed this to you last week. Now let's look at a little different view. And this is the yield curve history going back to 1990. And so this is the 210 yield curve. There's other yield curves. You can do 6-month 10-year, you can do 5-year 10-year, and so on. 2-year 10-year is widely followed. Probably others are just as widely followed. Well, let's keep in mind here that this pink line is zero bounded yield curve levels. And so there is definitely a history of the yield curve going negative. Now, what does that mean from the sense of the economy here? Well, what it means is that the yield curve is in a tight money situation. This is tight money, easy money timing. When interest rates, when the yield curve flattens, that means that we have a tight money situation. Tight money tends to slow the economy. You can see here that we have cases where we touched the zero bounded area, and I put the arrow up here where that happened. You can see that it sometimes produced a range bound condition, but then the uptrend continued. Here it had a bit of a correction, and then the uptrend continued. Here we had a bit of a we just had a little bit of a slowdown. Then it went up into the COVID peak and decline, which was substantial, but that was about 7-8 months later. And so it can result in a correction, but it can be followed by a continuation of the rising trend of the indexes. In this case, it's the S&P 500. But notice here, when the yield curve starts to live below 0 here and here. So in this case, this is around 2000, and look at this distributional top that we have in the S&P 500 at the time that the yield curve goes negative. This is a tight money environment right there. Then you have an 0607, you are living below the yield curve below 0 here, and you have, this occurs about, gosh, a year before the final high in the stock market. And look at how the stock market starts to distribute itself. And in both these cases, we had recessions. So I would contend right now, what do we know? We know that the yield curve is still positive. It may just go down and touch the area of the zero bound, but it might just stay above it. We just at this point don't know. But typically when that happens, we have maybe a correction, but we just as likely could have a continuation of the rising stock index values after that. So we'll keep looking at this. I would just say there's going to be a lot of discussion in the financial press about yield curves going negative and so on. And I would put that into the context of history and just say, again, what we want to do is we want to focus on what the markets are actually doing. Look at distribution and accumulation characteristics. Okay, so that's what I kind of wanted to cover there. And now let's move on, and we'll come back to this and do more on it. And so here is the New York composite. I haven't talked about that much here recently, but it's a great index to look at. This is all the New York listed stocks. And so you can see a sign of weakness here. And now a really good rally. I think we've done a great job of identifying the conditions for a rally in the market, and we got it. So we're feeling pretty good about that. Here's the S&P 500. This is what's happened since September. So you can see the attributes of distribution have occurred here. We've gone down on this point figure count, 60-minute 3-box reversal, 15-point scale. You can see we went right down and went right into the middle of this count objective range. And subsequently, we've rallied nicely from there. This chart hasn't been updated for a while, so I just wanted to mainly show you that this initial distribution count. Now, here, you can see that we could get a much bigger distribution count at some point. A point I want to make on this chart is here's what we call preliminary supply in Wyckoff terms. This is the first run up that has an important reaction, which is brief, temporary, and then the uptrend is resumed. This actually is very encouraging to people. And so people are encouraged because the uptrend keeps going, but it's a warning. This is a huge warning. And in fact, the buying climax followed in the next rally phase up, and thereafter range bound conditions and somewhat of a distributional formation is formed. Now, preliminary supply often is the point at which last points of supply will stop. Here you can see 2 attempts, 1 day only each, to get above that preliminary supply resistance and failure. And we're getting very close to that again. Now, there's reason to think that this is a pretty good rally and may have some additional momentum, but we'll have to come back to that and look at it later. Here, and so you can see that here is just the S&P as we've gone through, and it's come out of that upward trending channel. But all the way since 2011, these point figure counts have just worked really, really well. So let's see, what else can we do here that we have time for before. Here you can see, and we have about a minute left. Here's the triple Qs. You can see that into the fall, this is October, November, and here that we fulfilled 2-point figure counts and then became range bound, came back into the channel, formed a distribution, got a count. Here is that count, and you can see that we declined right into the area of that, which has subsequently produced a rally. And so that's really a very interesting condition. So let's go and look. Here's an update on the triple Qs. You can see how stellar this swing trading rally has been. Maybe in the context of the larger picture, it's still not significant, but it is promising. Thank you for staying on board for our overtime segment. Going to cover a little bit on the gold miners and gold futures, and then go into sector analysis in about 10 minutes of overtime. And so to start, let's have a look at the XAU to gold ratio. This is a relative strength, and relative strength in this case is the XAU gold miners index to $ gold, which is the continuous contract for gold futures. So by doing a ratio XAU colon $ gold, so $XAU, you can make a point and figure chart using, in this case, 2-point scaling. And here is a beautiful accumulation structure. This is a classic cyclic accumulation, which we talked about at the beginning of this program, and that each sector, each part of the market really marches to its own beat. And in this case, you can see that XAU and gold are starting to have some kind of a cyclic event that looks like accumulation. It is not yet out of this accumulation structure. It may have more work to do. So we talked about this last time. Look at this beautiful oversold condition right here in the trend channel, drawn on these 2 points right here, and then an oversold there, which is a climax, then a range bound condition with a last point of support, a sign of strength. Looks like we have another last point of support potentially forming. But once we get the XAU up and out, what that means for us is that we're starting to see gold miners outperforming gold. And that is a very healthy relationship for that sector. And so let's have a look here at the, and there's a point and figure chart, a count. This initial count, which is very conservative, 126, 136. Now keep in mind, this is the ratio. So this is not actually prices. And so we're looking at a ratio that currently is around 80, being able to go up to 126, 136, which means that a rising line is a sign of relative strength outperformance. Now, in this case, miners to gold. Gold might go down, miners go down less. Gold goes up, miners could go up more. We don't know directionality-wise how this is going to unfold. It appears that it's going to be some kind of a positive event. Well, let's look at the chart on the left. So the chart on the left shows a reaccumulation type structure after a big base from 2016 over to 2020. Here's the COVID reaction, makes a slightly higher low, good rally up into mid 2020, now in a reaccumulation. Well, look what's happening. This is the XAU to gold. This is just drawing that relative strength line with a with gold. Below is the relative strength line to the S&P. So now we're looking at both relationships. We can see here that the gold miners are very close to making a relative strength high against gold here in this middle panel. The lower panel, we have a turn upward above the trend line and this the moving average line. And so we can see here that now we're starting to see what we would say is that gold miners are starting to outperform the S&P 500. And that's what we look for in the characteristics of all stocks that we're interested in trading. So over here, you can see the downward slope and living below the moving average. That is underperformance to the S&P. Same is true here. This is underperformance of the miners to gold. but now we have a reverse condition that's occurring, and it's about to reassert itself again. Something to keep an eye on. I wanted to show you that because this is the way we like to think about sectors and groups to indexes, because the institutions in fact think this way. StockCharts.com is just really a magnificent tool for being able to work our way through from a top-down perspective, which is my preference, through the markets and be able to find what's working, what's not working, what is in the process of turning from down to up to down. And how I like to do this is what I think is absolute X-ray vision, is by looking at relative strength, starting with the sectors. Well, literally starting with the indexes, which we covered in the first half hour, then going to the sectors, then the industry groups, and then individual stocks. We're probably not going to get much past sectors, maybe a little group work today, but we'll spend more time next week on it. I want you to look at these thumbnails. These are CandleGlances. They're fantastic. You can go in and make these very, very easily. Just go to Chart Tools, go down to Sector Summary. You can see here the sectors, and then just go CandleGlance. And then what I'd like to do is go to a 6-month time frame. I add the indicator of a price relative, which defaults to the S&P 500. And here you can see you have 6 months of data, the S&P on the left, and the relative strength underneath. Fantastic. Look at just the sheer amount of information you can get by looking just at the 6-month CandleGlance view. So let's just go right across. So discretionary has been really out of favor since November. You can see it got below the moving average on relative strength, formed a distribution up here, and has been in a downtrend. It's trying to flirt with basing on the relative strength and has rallied up to the moving average, which is also a resistance area. This might be a cause. Well, we can zoom in. Now, what I do is I default to this chart I like to look at, which is a little bit longer time frame. This is weekly data, XLY, discretionary, relative strength on a weekly basis, and you can see that on the weekly time frame, discretionary is in a downtrend both in relative strength and price. Place of vulnerability in my mind, especially with this rally phase up into the 39-week moving average. So let's go back. Here is communication services, downtrend both in price and relative strength. This is a very weak group at this time. Technology, which has been so important for so long. And so you can see here that technology has built some kind of a distributional top and has been in a downtrend. Relative strength did not confirm the last high in technology here. Look, you can see all this just looking at these CandleGlances. Downtrend is in force. We've rallied up into the downtrending moving average. Place of vulnerability, possibly a base is forming here. So we'll be hopefully encouraged to see an attempt to rally up to this 165 level. Technology is really important to the speculative mood of the marketplace. So we'd love to see technology get back in gear on the upside. Industrials, I think, are one of the bright spots. Look at the industrial relative strength making higher lows throughout. And here is a nice base that's formed here across this area. It's up into resistance, a little sign of strength here. Now it's pulled back on this last attempt to go into the resistance. May have to do some work here, but this is a nice uptrend. I would be going into the industry groups and stocks looking for leadership here. Materials, well, we all know how the inflation picture has unfolded here in 2022. You can see that materials in the first quarter have been generally in a downtrend, but look at the relative strength. Relative strength tells a different story. It shows that prices are rising, and we can see that the materials sector wants to go down at a slower rate, creating positive relative strength. Beautiful rally off this low here. And this rally suggests a sign of strength, which is a really good indication that there is a very good shot at materials getting up to the prior highs. And this could be very well be a big base that we would want to consider counting on a point and figure basis. Also, you can make cool point and figure charts on the candle glances. And so maybe we'll just do that quickly at the end. Energy has been so stellar for so long. Look at this, 2022, it's just been leadership after building a base back here. And so relative strength has continued to be very strong. There's no reason to expect that it would be any different than this. We may be range bound, but look, here is the weekly view of energy, the sector, and you can see, look at the big base in the relative strength on a weekly basis. As early as the middle 2021, there was an uptrend forming in the moving average. The relative strength is living above the moving average, and look at the trend of prices. So for a very long time now, energy has been one of the dominant themes in this market. Staples, downtrend. Look at this, relative strength down, distribution, prices down. I'd be very careful there. Really like healthcare. Look at the uptrend. It's really been in a relative strength uptrend since the fourth quarter. So big base is formed here. Upwards it goes. I would be drilling in to the industry groups and stocks in this sector and looking for good leadership. Utilities, great defensive theme, good yields. And you can see here it's just been up on a relative strength and a price basis throughout. So that's really good. I'm very heartened by the performance of the financials here recently, but you can see that this is a top in the relative strength. Good rally off the lows, not much of a base is formed, but there might be some good individual themes inside the financial sector. I'm intrigued with some of the insurance industry groups. So that's where I'm spending time studying. Real estate, look at the big decline here in real estate in the rally in the market. And so you can see that the relative strength has been quite weak. It's broken an attempt to go into an uptrend. I would be extremely cautious with real estate here just because of the recent weakness. Okay, so there are some examples of how we would use the industry group work. Now let's just take a minute and make a point and figure of these and look at these. They're fantastic. So you can really see the structures of these accumulations and distributions with a CandleGlance view, and then you can zoom in and look at them more closely or even do point and figure counts. So really good stuff. And so from there, we are going to move on and look at some industry groups. I'm going to pause for just industry groups is the next level down from sectors. And what I have done is I've actually made a list of all the industry groups that are the Dow Jones groups and also some ETFs, so that I can go in and look at them in the same manner that we just looked at sectors. So let me just show you here. We can go here and charts and tools. And if we go over to industry summary, we can see, and I like to do the table view, but the chart view is quite good too. Here are all of the industry groups listed by their sector. Here is the discretionary, which we looked at, and you can see automobiles, apparel, toys, furnishings, home improvement. And so they're all in here. And then you can make a chart by just clicking on the link here, the icon, or you can go in and you can click on auto parts. So let's say we look at the auto parts, and this has been a weak group. Look at the distributional top. The relative strength far preceded the group itself, weekly chart. I always default to this view. And also, if you go up here and put in the view that gives you more information, it shows you the industry group. If you put up a stock, the industry group in the sector that it's in. So here, look how the relative strength has really been sagging. This is not a leadership group. Here, Once you start to go into a downtrend on relative strength, it just generally lives below there. Attempt to get above on the 39-week here, but unconfirmed by the relative strength. And so now let's go back. Let's say we wanted to see the auto parts individual stocks. This is the way I like to do it. Here is the list of these stocks. Is number one, look at the market cap, largest first. So these are the leadership stocks. The institutions must own these stocks first. When they start to get interested, they will go to large cap with liquidity and then work their way into mid cap, where there might be more growth or more interesting stories going on. Then the other thing to look at is to sort by scooter. So Tenneco has got a 92, and then immediately they fall off. You can see the group has got scooters that are in the 50s and 60s for the most part and lower. That's really a sign of the weakness in the group as a whole that we just looked at. So see how it's just remarkable how we can go right in and look at these. Here are the scooters for the industry groups over here on the right, food products. So let's go in and make a chart of food products. And here, a nice uptrend. It's very near its prior highs. A base is trying to build in food products on relative strength. The moving average is not turned up yet. We get more excited when we see the moving average turned up, relative strength above it. Same with price above its long-term moving average, but we're awfully close. So this would be a group to watch very, very closely, especially being it's near breaking out. And look at the gigantic base that's built a foundation below this level. So accumulation of a large scale, reaccumulation here, and then both of these potentially could start a new relative strength uptrend. Pretty cool. And then if you want to see the individual stocks, you just click on the name and you'll be able to see the stocks, sort by first by market cap, the U, and then sort by scooters after that and see what's performing best. That is such a quick way to be able to really scan the most important ideas in a group. Now let's get back to this list here, industry list. So you can see that I have 5 pages of these groups. And so you can see across here what seems to be performing well and what isn't. So look at this nice relative strength uptrend just by scanning and looking. New highs set in price. Let's open this up. And this is US mining, the mining index, and big reaccumulation structure up and out. May have to pause in here, but a shallow backup with low volume would be most constructive. And you have relative strength now confirmed up. Institutions start to pay attention when they see this, because these themes are the ones that are going to contribute to their outperformance, which they so desperately need. Okay, on that, I'm going to stop here. We will pick this up next week. Let me know what you think. We'll do more of this, and then we'll get into stock selection with the industry group analysis in our next get together. Have a great week. We'll see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.